You know that eerie calm right before a tsunami hits?
Oh, yeah. The water just pulls way back.
Exactly. The water pulls way, way back from the beach,
Huh.
and the sand is exposed. Everything goes perfectly quiet.
Right. And if you don't know what you're looking at, you might just think it's a beautifully, uh, unusually low tide.
You might even walk out there to pick up seashells. But that quiet isn't peace, it's physics.
Hmm.
It's the ocean pulling back to gather the energy for something massive. Welcome to the deep dive. Today is Friday, March 27, 2026. And if you look at the surface of the global financial markets right this second, there is that exact same eerie, almost contradictory calm.
It really is the absolute definition of the calm before the storm. I
Yeah.
mean, it's a structural illusion that the vast majority of market participants are taking completely at face value.
And that brings us to our mission for today. We are looking at a brand new, highly analytical market situation report.
Just dropped on March 24th, right?
Yep, just a few days ago from analysts Pheneck and Miad Kasravi. And it is a dense, incredibly detailed read. But we are zeroing in on a singular, chilling thesis buried in their charts.
The structural flip.
Exactly. The underlying structure of the global market hasn't just weakened, it has completely flipped. And a systemic event, something they're calling Volmageddon, is quietly, methodically building in the background.
Yeah, building right under everyone's noses.
So whether you are actively managing a portfolio, prepping for a Monday morning finance meeting, or, you're just intensely curious about the hidden tectonic plate shifting under the global economy, this deep dive is your shortcut.
Right, a shortcut to understanding a massive shift that almost no one else is paying attention to.
Okay, let's unpack this.
Yeah.
Where do we even begin to see the water pulling back?
Well, we really have to start at the very top with the S&P 500. That's how we grasp the foundational mechanics of this report.
The broad market.
Right. For 3 weeks leading up to this publication, the analysts tracked a specific behavioral pattern with, surgical precision. They observed what's called an inside monthly candle failure.
Hold on, let me jump in here. Inside monthly candle failure sounds like something you'd find at a Yankee candle clearance sale.
That's fair.
In plain English, what behavior are traders actually exhibiting on the floor or on their screens to make that pattern appear?
So let's strip away the jargon. Imagine a chart showing the market's price range for a whole month. An inside candle means the entire month's price action stayed completely within the high and low of the previous month.
Okay, so it's trapped.
Exactly. It's compression. It's a coiled spring. When that spring finally snaps and breaks below the bottom of that previous range, that is the failure.
I see.
It means the buyers who were defending that floor have surrendered. And what happened recently is that the S&P 500 dropped and hit a mathematically mapped target of exactly 6,510.
6,510. And that wasn't a random number, right?
Not at all. It was what we call an open downside liquidity pool. And the market deliberately swept it right after the FOMC announcement and the quad witching expiration.
Let's break that down real quick. A liquidity pool at 6,510. What is that exactly?
Think of a liquidity pool as a giant cluster of tripwires. Retail traders and smaller funds often place their stop-loss orders just below obvious psychological levels, to protect themselves.
Right, so if the price drops to that level, their broker automatically sells their stock to stop the bleeding.
Exactly. But institutional algorithms know exactly where these clusters are. They will intentionally drive the price down into that pool, trigger all those automatic sell orders, and then use that massive wave of selling to buy up shares for themselves.
Wow. And you mentioned quad witching. That's just when 4 different types of financial contracts, options, and futures all expire on the exact same day, right? Which forces a ton of mechanical trading.
Spot on. So the market goes down, hits 6,510, triggers all those sell orders, sweeps up that liquidity. And in a normal world, you'd think, well, great, the flush is over.
Right. The big guys got their shares. Time to buy the dip.
But Kasravi's data is screaming that this is definitively not a normal pullback. The market structure has flipped bearish, and it has done so on 4 time frames simultaneously.
Wait, 4?
Yeah. The weekly, the 3-week, the monthly, and the quarterly charts all at once.
4 time frames all agreeing. That sounds intense.
It is. In over a decade of tracking algorithmic price action, a structural convergence of this magnitude, where every macro time frame aligns bearishly, is exceedingly rare.
Wow.
When the previous quarter's low is taken out, the big money algorithms don't read that as a discount. They read it as a systemic restructuring. The upward trend has mathematically broken.
But wait, I have to push back on this because there's a paradox staring us right in the face here.
Let's hear it.
If every major macro time frame is flashing bright red, sirens wailing, shouldn't market fear be absolutely skyrocketing right now? Why is the VIX, the volatility index, Wall Street's literal fear gauge, actually declining alongside the market?
What's fascinating here is the psychology behind exactly that paradox. The report calls it the VIX deception.
The VIX deception.
Right. Typically, when the S&P 500 drops, the VIX spikes because investors get scared and rush to buy put options, basically insurance policies on their portfolios.
Makes sense.
But over the last 2 weeks, the S&P has trended lower, and the VIX has just drifted lower right alongside it. It is a textbook signature of extreme complacency.
It reminds me of a guy casually mowing his lawn while a tornado touches down a mile away.
Yes.
He looks straight up, sees a patch of blue sky directly above his house, and assumes he doesn't need to check the radar. He has no insurance.
That is precisely what is happening. A couple of weeks ago, during a brief geopolitical flare-up, the VIX had a tiny spike. The market mistakenly interpreted that minor event as the climax of fear.
Like, oh, the worst is over.
Exactly. But because the VIX is now trending down while the actual underlying market structure is breaking, it tells us that the real fear hasn't even begun to be priced in.
So nobody is buying insurance.
Nobody. And that lack of hedging is exactly what provides the fuel for a massive volatility expansion later. When the drop really accelerates, everyone rushes for the same tiny exit door at once to buy protection.
And the price of that protection just explodes.
Right. The report projects that the real spike in volatility is still ahead of us, with quarterly targets for the VIX looming somewhere between 59 and 66.
A VIX in the 60s? Just for context, a normal VIX is around 15. Hitting the 60s is full-blown systemic panic territory.
Yeah, that is 2008 or March 2020 levels of stress.
Which logically brings me to my next major point of confusion. If the broader S&P 500 is fundamentally collapsing, why is the tech-heavy NASDAQ still appearing so resilient? I look at the NASDAQ and it feels like it's operating in a totally different reality.
It is operating in a different reality, but it's a mathematical illusion.
An illusion.
Yeah. The NASDAQ's resilience right now is completely manufactured by market cap weighting. Because the index is weighted by the size of its companies, a giant can hold up the whole index even if the smaller companies are dying.
Ah, I see where this is going.
Right now, the NASDAQ is being propped up almost entirely by a single stock, NVIDIA. The price action on NVIDIA and the overall NASDAQ index are virtually identical.
So it's basically the NVIDIA index right now.
Pretty much. The index isn't showing its bearishness yet, simply because that one massive pillar hasn't given way.
So what does this all mean? It's like a game of Jenga. We're looking at the top block NVIDIA and thinking the tower's fine, but you're telling me Microsoft, Micron, and LRCX, the bottom foundational blocks, have already been pulled out.
The concrete is absolutely cracked.
Yeah.
And the biggest foundational pillar sitting underneath that penthouse is Microsoft.
Right.
Microsoft was the primary engine that drove the massive 2022 market recovery. But if you look at the mechanics in the charts, Microsoft has already shattered its quarterly support.
Wow.
It's currently trading at levels equivalent to a NASDAQ at 19,255.
Wait, really? Because the actual NASDAQ is sitting much higher than that?
Exactly. This creates a massive open gap between 20,061 and 20,613.
So there is essentially an air pocket sitting directly underneath the NASDAQ index right now. And gravity always wins.
Always. Because Microsoft makes up such a massive percentage of the NASDAQ's total weight, the index mathematically cannot stay afloat if Microsoft's stock price sinks.
It has to catch up.
Right. When the new quarter opens, the NASDAQ is going to be forced to play a brutal, accelerated game of catch-up with Microsoft to close that gap.
Ouch.
And if we look closer at the other foundational materials of that Jenga tower you mentioned, the semiconductor sector, tracked by the SMH ETF, we see the cracks turning into craters.
Right. The source data specifically calls out Lam Research, ticker LRCX, and Micron, ticker MU. What's happening there?
Both of them are showing critical structural failures. LRCX has broken its market structure by taking out the previous month's low, and it's currently just drifting at a weak counter-trend bounce.
A dead cat bounce.
Exactly. But Micron is perhaps the clearest window into the market's exhaustion. Micron had a classic sell the news earnings trap.
Explain that, because it always baffles people. They reported great numbers.
Outstanding numbers. I mean, They reported strong profit margins. They gave highly positive forward guidance for the rest of the year, and the stock still went down.
It's just wild to think about a company coming out, posting fantastic profits, and the market essentially saying, yeah, we don't care, we're selling anyway. Why does that happen?
Because the great news was already anticipated and completely priced in by the institutions. weeks ago. When the good news officially hits the headlines, retail traders rush in to buy.
And the big guys use that.
Right. The institutions use that sudden surge of retail buying that liquidity as their exit strategy. They sell their massive positions to the excited retail traders.
Leaving retail holding the bag.
Yep. It created a false breakout, a double inside weekly candle pattern that swept up the liquidity at the top before reversing hard. It shows total exhaustion.
No more buyers.
There are simply no more buyers left to push the price higher, no matter how good the news is.
That is brutal.
And it's a pattern we've seen before. These counter-trend rallies in the semiconductors perfectly mirror the false rallies we saw right before the massive 2018 Bitcoin bear market.
Oh, that's an interesting comparison.
Back then, Bitcoin breached a minor higher low, gave a weak bounce that convinced retail traders the bottom was in and the bull market was back, and then completely rolled over, dropping another 70%.
Wow.
The semiconductor sector is tracing that exact same exhaustion pattern right now. When Lam Research and Micron finally roll over, they drag down the SMH ETF. And when the SMH ETF drops, it pulls down NVIDIA.
And there goes your glass penthouse.
Exactly.
Okay, if this entire tech skyscraper collapses, all that money doesn't just evaporate, it has to go somewhere. Usually we hear about sector rotation, the big funds move their money out of high-growth tech and just park it in safe haven healthcare, or stable utility stocks that pay dividends. Are you saying this isn't a rotation at all?
If we connect this to the bigger picture, the data explicitly shows this is not a sector rotation. Capital isn't hiding in defensive stocks.
So where's it going?
It is exiting the equity markets entirely. This is a definitive global cash flood. And the master key to understanding this entire macro puzzle, the reason why the money is fleeing, is the U.S. 10-year yield.
The 10-year yield, the bedrock of the global financial system. The report notes it's aggressively spiking, targeting 4.4595 and 4.627. But what is the actual mechanism there? Why does a rising yield kill the stock market?
Think about it from the perspective of a massive institutional fund manager who handles billions of dollars. Your job is to generate returns while managing risk.
Right.
If the U.S. government, the safest borrower on the planet, is suddenly offering you a guaranteed risk-free return of 4.5% or higher on a 10-year bond, why on earth would you risk your capital in a wobbly stock market sitting on an air pocket?
You wouldn't. You'd take the sure thing.
Exactly. As the yield spikes, it acts like a giant macroeconomic vacuum cleaner. It pulls capital out of risk assets all over the globe and funnels it straight into the U.S. Treasury market.
And to buy U.S. treasuries, you need U.S. dollars.
Right. Which means the value of the U.S. dollar, the DXY index, starts coiling for massive breakout. It's a chain reaction.
Yes. There is a direct inverse relationship. As yields rise, the dollar rises. As the dollar rises, global risk assets fall.
Everyone is piling into cash for shelter. And because the dollar is coiling for this breakout, the Kasravi report highlights some incredibly high-conviction short setups in the global forex market.
Right, the foreign exchange market. The report calls out the Australian dollar against the US dollar, the AU or USD, and the British pound, the GBP USD. Let's dig into those because a source mentions an AU USD setup that is a 5.59 risk-reward swing short.
Yeah, that's a massive setup.
For someone not trading currencies every day, what does that mean, and why is the Australian dollar specifically in the crosshairs?
A 5.59 risk-reward ratio simply means that for every $1 a trader risks losing on the trade, they stand to make $5.59 in profit if the thesis plays out.
It's an incredibly asymmetrical bet.
It is. And the reason the Australian dollar is so vulnerable right now comes down to commodities. Historically, the Australian economy, and therefore its currency, is heavily propped up by the export of precious metals.
Okay.
But the report notes that gold has recently topped out and is showing weakness.
Ah. So if gold is falling, the floor underneath the Australian dollar vanishes.
Precisely. With that support pillar removed and the U.S. dollar surging like a freight train, the Aussie dollar is defenseless. It's completing a structural failure on the 3-week chart, targeting significantly lower levels.
And the British pound.
The GBP USD setup is also a prime short, sitting at a 2.9 risk-reward ratio. It mirrors the dollar's strength perfectly, forming a daily bearish order block.
So it's everything across the board.
When you see the entire Forex complex offering a unified directional thesis like this, where every major foreign currency pair is screaming that the U.S. dollar is about to bulldoze them, it validates the broader macro view. The global liquidity drain is already underway.
Okay, so if cash is aggressively draining from global equities, from the tech sector, from foreign currencies, and it's all rushing into the safety of the U.S. dollar, I have to ask how the ultimate speculative high-risk asset fits into this dire landscape.
You mean crypto?
Yeah, what about Bitcoin? If money is fleeing risk, Bitcoin must be dead on arrival.
Yeah, that is the crypto paradox right now. You would absolutely think Bitcoin would be the most vulnerable asset in a liquidity drain. But the math tells a slightly different story.
How so?
Think about where we are currently. Bitcoin is already down about 52% from its all-time highs. Meanwhile, the Nasdaq, as we discussed, is only down about 10% from its peak.
Right. The report describes Bitcoin as a beta to the Nasdaq's alpha. Meaning what, exactly?
It means it's a follower, but it moves with massively amplified volatility.
Yeah.
If the Nasdaq drops 10%, Bitcoin might drop 30 or 40%.
It overreacts.
Exactly. Because of that highly sensitive asymmetric relationship, Bitcoin actually moves faster than the traditional market. It has likely already priced in the catastrophic crash that the Nasdaq is just about to experience.
Wow.
It has already flushed out the weak hands, resolved its open inefficiencies, and tested the previous quarter's low.
So you're saying the pain in crypto has essentially already happened. It front-ran the tech crash.
Largely, yes. The report does not expect Bitcoin to experience another 70% drop from here. Instead, it expects Bitcoin to enter a prolonged multi-month range, just chopping sideways between roughly 60,000 and 74,000 while the rest of the market burns.
That's wild.
They even highlighted a spot entry for long positions down at the previous quarter's low.
That is fascinating. While the rest of the traditional market is stepping up to the edge of the cliff, blindfolded, Bitcoin might have already hit the canyon floor, dusted itself off, and set up camp.
That's a great way to put it.
Which brings us to the grand finale of this report, the macroeconomic endgame. We have quarterly bearish signals across the entire S&P. The semiconductor concrete is cracking under the NVIDIA penthouse. We have the VIX deception hiding extreme complacency and a surging U.S. dollar sucking liquidity out of the room. All of this leads to what the authors call Volmageddon.
Yes, the Volmageddon event, a violent, unavoidable spike in the VIX, and a genuine, terrifying flush of the global markets. And what makes this so critical to understand is the timing.
The transition.
Right. This impending crisis coincides perfectly with a massive leadership transition at the highest levels of global finance.
May 2026. Jerome Powell departs as the chairman of the Federal Reserve.
Correct. And Kevin Warsh, selected by Scott Bessent, is slated to step in. This new regime is widely expected to deeply coordinate fiscal and monetary policy.
They're bringing the big guns.
They're going to come into office with a proverbial money-printing bazooka, fully loaded and ready to deploy to stimulate the economy. But there's a massive catch. Central banks do not fire bazookas preemptively.
Right. They can't just print trillions of dollars while the market is relatively quiet. They need an excuse. They need a crisis to justify the intervention to the public and the politicians.
Exactly. They need Volmageddon to happen first.
Here's where it gets really interesting. So the biggest, most lucrative generational wealth opportunity actually requires the deepest systemic pain to trigger it.
That is the ultimate contrarian takeaway of this entire Kasravi report. The indices must crash first.
It's a prerequisite.
You need the S&P 500 and the Nasdaq to break down structurally. You need capital to completely flood into the dollar out of fear. And you need to create undeniable systemic credit stress.
And then they step in.
Once that genuine fear grips the market, when the VIX hits those 60 levels, the new central bank regime will step in with overwhelming force to save the day and arrest the credit crisis. The massive liquidity injection that follows is what will create the generational buying opportunity.
The survivors get the spoils.
The traders who survive the Volmageddon flush those who hold their capital in the safety of U.S. dollar cash and patiently wait out the storm will be perfectly positioned to buy assets at rock-bottom prices.
It's like having the discipline to board up your windows and weather a Category 5 hurricane just so you can walk out the next morning and buy the beachfront property next door at a 70% discount.
That is exactly the macroeconomic dynamic at play.
Let's take a breath and recap the journey we just took because it is heavy, but it's crucial. We started by looking past the eerie calm of today's market to see the hidden structural cracks in the S&P 500 timeframes, unlining in a rare bearish signal. We uncovered the VIX deception, where the guy mowing his lawn in the tornado proves that low volatility is actually a mask for extreme complacency. We exposed the Nasdaq's illusion, realizing that the tech's right. And we followed the money, watching it flee equities entirely, sucked into the U.S. dollar as risk-free yields aggressively spike. All of this pointing to Volmageddon, the ultimate market flush that paves the way for a massive central bank rescue mission by mid-2026.
Exactly.
Now, as always, we want to remind you that this is an analysis of a deeply technical market report, not direct financial advice. But understanding these mechanics, seeing the water pull back from a beach before anyone else even notices the tide has changed, puts you miles ahead of the complacent crowd.
It absolutely does. And uh, analyzing all this data, looking at the end game, this raises an important question. One that the report leads us right to the edge of, but leaves us to figure out for ourselves.
What's that?
If the entire market safety play right now is to flee into cash, to pile into the U.S. dollar, to weather the Volmageddon crash, what happens to the purchasing power of that cash? The exact moment the new central bank regime fires that massive money-printing bazooka.
Oh, wow.
Does the very cash that served as your safe shelter during the hurricane suddenly become a trap of its own once trillions of new dollars flood the system and ignite inflation?
Wow. If the shelter becomes the trap, how do you time stepping back out into the storm? That is a heavy thought. Something for you to ponder as you watch that eerie calm on the charts this week. Thanks for joining us for the deep dive. We'll see you next time.